What is up, ladies and gentlemen? Was the countdown timer frozen for you?
I don't think so.
Oh, okay. Just kind of took me by surprise there.
Yeah.
Anyway, I wasn't doing anything suspicious. So it's totally fine. Welcome everybody. It's Monday. This intro is the most Monday thing that could happen. But we are ready to tackle the week. My name is Sean Grapevine. I am Vice President of Product Strategy here at U Mortgage, and I am joined by Matt, the mortgage guy, Gouget.
Happy Monday, Matt. Brother. How you doing, man?
Good. I'm doing great. I feel rested. I feel ready to take on the week.
That's good. I actually got a good night's sleep last night. I think that's what I needed.
I know I did too, and I woke up and I was like, I should do this all the time.
Yeah,
I feel like $1 million.
You want to hear something personal?
I do. But just so you know, this is live, and there's like thousands.
Everyone on the internet is my friend, Sean. We're all.
I just wanted to make sure you knew that you're as famous as you are.
So I breathe out of my mouth, and I know it's a problem. My wife's trying.
Even like when you're awake or when you're asleep.
Yeah, like my wife last night. We're laying there just chatting about the week and a bunch of different stuff with the kids, and she's like, "Close your mouth. Just breathe out of your nose. That's like." It's better for your brain. So one of the reasons I think I got a great night's sleep is I tried this because I've seen it. I taped my mouth shut. Yeah. So I was forced to breathe out of my nose all night, and I think more oxygen got to my brain. You might notice in this episode, Sean, I might be a little bit sharper. I might be a little bit better today.
One can only hope.
With that,
maybe you have like a, maybe you should see like an ear, nose, and throat specialist. Maybe you got like a deviated septum.
I did that. I did the septoplasty, and I still have problems.
It didn't work. Maybe you should tape over your mouth like while you're awake too.
I promise everybody we're gonna talk about mortgage eventually, but just real quick, if you're ever thinking about having a septoplasty, don't do it. Like a UFC fighter did it after a fight, and he was like, "This is the worst thing ever." Plastic stents stay in your nose for like a week. Not a good feeling. It's the worst ever. And quite honestly, I don't think it helped me that much.
Wow. All right. I had one scheduled, but I'm gonna cancel it.
Yeah. So if you think buying a home is difficult, try having a surgery where they stick plastic up your nose and leave it there for 7 days. Yeah, let's talk mortgage.
Speaking of things that have gone up for the last 7 days. Huh?
Great transition, man.
Thank you. Well, it's time to look at mortgage rates, and as much as you want to ignore what's happening here, you can't. Interest rates continue to rise, but again, it's like we talked about last week, Matt. Like interest rates only go up when we get good news about the economy. So this is not all the doom and gloom that we expect, and I think we still expect interest rates to go down over the long term, which we'll get to. Just maybe not as quickly as we once thought. If you see here, interest rates are maybe around 6.5, a little higher than that, depending on the scenario for a conventional loan, and maybe in the high 5s for VA loans, low 6s for FHA. And that's really not as bad. Like they've gone up rather quickly, but like really only to the levels they were at on August 15th or something like that, which at the time we were celebrating that they had gone down. It's like you always say, like nobody actually cares about the nominal number. They just care about like there's recency. It's like whatever, like let me compare it to 2 weeks ago. If it's higher than 2 weeks ago, oh no, rates are high. If it's lower than 2 weeks ago, oh yes, rates are low. The whole like what the actual number is, nobody seems to ever remember.
Right. Doesn't matter as much as the direction and what their friend got 2 weeks ago. So you're right. And I think there's something about the timing of this little kick up in rates that like we talked about last week, is causing the market to feel different in different parts of the US. I know for sure in my market, we're feeling like the seasonal slowdown. And then if you pump some extra brake, which is rates going up, like just so everybody's super, super clear about this, mortgage interest rates affect demand. No matter what time of year it is, when
100%.
rates go up, demand goes down. When rates go down, demand goes up. And so if demand is trending down because it's a winter month, it's the fourth quarter, and that happens every year. That's how real estate and real estate demand works. If you've got that trend down and then you pump the brake of rates up, demand down as well, you can start to see some stuff, days on market lengthen, people get deals. But like the clip that we used from last week, you said it really well, Sean. That kind of toughness in the market, that little blip, which is, to a lot of people, bad news or harder to buy or less reason to buy, makes it better for everybody who's active in the market. If you're going to buy a home in Q4 of 2024, that's good news for you. Less buyers, less competition, lower prices, more concessions, all those things happen when we get that, what appears to be bad news of, hey, rates just ticked up 0.5% over the last 2 weeks of September.
You're right. I did make a really good point.
Oh, you crushed it, man. You just nailed it.
Yeah, all over.
You must breathe through your nose.
I try. Well, interest rates continued to go up last week for a pretty specific reason. I mean, there's the continued, curiosity about what the Fed will do in their early November meeting. But we also got a very big CPI report. CPI is the inflation report. It's probably paired with the jobs report. We get one of each month. Probably those are tied as the most important reports that the Fed uses to gauge, what their interest rate policy is going to be. And if a lot of jobs are created, then they won't be encouraged to reduce rates because it means the economy is healthy. Like money doesn't need to be any cheaper. It's cheap enough that people can spend it to hire people to do things. And CPI is kind of the opposite, right? As long as CPI is going down, as long as inflation is going down, which it went down to 2.4%, the annual inflation rate, 2.4%. Now and there's something called core CPI, which takes out transportation and housing and energy costs. And that's like on the stuff that you can actually go buy that's not seasonal. Now that is a little bit higher at 3.2%, but still way, way lower than it's been in quite some time, since 2021, and trending in the right direction. And, it's just another piece of good news that the Fed can point to and say, hey, inflation's still on its way down, but the good news for them was it went down. It's just ticking down. So it's not like, hey, we've got the super tight monetary policy, which is meant to drive inflation down. It's not like it's just plummeting and they're like, oh my God, we got to get some money back into the economy so that we don't like go into some deflationary spiral. It's just like, it's really like, they talk about the soft landing and you can see it in the CPI chart where it goes just nice and steady, where they're going to land it right at 2%. And you show the Fed that, it's their wildest dream come true, right? It's what they've always been saying they wanted. And what they themselves have said, hey, it's pretty unlikely that anybody could ever have an actual soft landing. You know what I mean, Matt?
I know exactly what you mean. I'm responding to somebody in the comments. We'll talk about that later, but
fine.
let's chat with let's chat some of these numbers and some of the
let's get through it. Let's get through it. Let's get through
the people.
Let's get through the numbers. And anybody else who has questions, drop them in the chat. So, probability of a rate cut during the next meeting, the next Fed meeting on November 7th, remains basically unchanged from last week. There's a 15% chance that there will be no change, about 14% chance there will be no change, down slightly from the 15.6% chance of last week, and an 86% chance of a single bump down. There is, if you go forward to the December meeting, there's a 1.2% chance, no change. That's the first time we've seen this. There's a 1.2% chance that not only is there no change in November, but there's no change in December. People are starting to think that we might end the year right where we are. Now, not very many people, and it's an incredibly low chance, but like it's back on the table, which it hasn't been in a long, long time. So the winds of expectation are changing, and those winds of expectation are not just, fancies fired off into the swirling mists of the night. They are they affect those expectations affect interest rates, and that's why interest rates are going back up, because that is the cost of expectation is built into today's interest rate, interestingly enough. So 20% chance of a single bump down from where we are in December, and still the most likely is a second bump, a bump down in November and then a bump down in December. So we're hoping for that. We like that. But again, if these come to pass, mean, hey, employment reports are good, CPI reports are good. Like we're not afraid of these.
Yeah, and I think that's like I just want to make this point because you're exactly right, Sean. Like the expectation changing is what affects mortgage interest rates. Everyone thinks it's the date of the meeting and when the Fed actually takes the action, but it's not. Like if we expect 2 more cuts before the end of the year and we get one, rates will go higher, and what the Fed says about what they plan to do in Q1 and how these charts start to shape out for 2025 meetings, like that's going to affect interest rates. But the day the cut happens, like it's already been projected. We've already got a good idea. And like, as that day approaches, these numbers change. And so people need to keep in mind, it's not like, we're the only ones that see this data. We're the only, so we've got some advanced notice, right? They're talking out loud, and they're like, they know that one way to move markets is to talk about it. And so they do that. Like that's one of their tools. Like the cut is part of the tool bag, but so is the conversation around it.
Mm-hmm. Yeah, exactly. And that's Matt and I's goal too. We feel like we have as much sway as the Federal Reserve, board of directors. And so we're trying to, everything we say is to move markets, baby.
If we get time later, I'll show you why we're going to get to 4.5% interest rates, Sean, but it'll be time dependent. It might have to wait till next week. It's
well, I didn't know this was an option. All right, sweet. Well, okay. I'm going to hurry up. If you look at this, if you look at January here, you got, again, crazy that it's on the board at all, a 0.3% chance that we are at on January 20th, the exact same rate, federal funds rate, as we are today on that day. That's insane.
That would take 6%. A lot of positive economic data for that to happen.
Yeah, in fact, I think it would border on pretty bad economic data. So that would mean inflation's actually going back up. It means the job market's overheating. Like I think that would be like, if that comes to pass, that means that interest rate hikes are also going to be on the other side of this chart, back on the table as well. Don't you think? I mean,
yeah, that would be wild. Yeah, it's very unlikely.
So yeah, we're not fans of that. Like I don't care about it not changing. We definitely, but there is some, like, it not changing means a pretty big departure from the current trend of data. And that departure would mean, like 350,000 jobs, right? Interest rate or CPI, the inflation rate back in the 3s and 4s. So we don't want to see that. 6% chance of one drop down from today, 34% drop, a percent chance of 2 drops down, and then the biggest one is yet another. Just like people still think what the Fed basically said they're going to do is what they're going to do. Like every month, just every meeting, 1 drop down until we've gotten back to where we want to be with that soft landing. So really interesting stuff. I love how this stuff changes. I love how assured. I love it when it's like a 97% chance one week of this one thing happening, and then like the next week it's like, oh, actually could be this other crazy situation. It's like, well, you weren't really that sure. Like, what does chance even mean at this point? You guys are just, it's like yeah, nobody's held to anything. So it's always super interesting to me. Let's jump into these questions, Mr.
Yeah,
Gouget.
Carrie's got a good one, and I always like to give people great advice when they're in contract, because that's a good time to get good advice. When you're spending $1.125 million on a house, you want to make sure you've got your mortgage structured properly. Lender is offering a first and second loan HELOC. Have you heard of this? So great question, Carrie. It's definitely something that I've heard of. It's something that I've structured and done for clients. It really depends on your credit score, your down payment. And I would love to, I put in the chat, email me at matt@mtmg.com. I'd love to look at it, conversate with you. There's plenty of companies, UWM first, Symmetry second. Depending on who you're talking to, they might still be at 766, 550 as a max for the first. Some companies have started to write those conforming loans up to 803,000. I think Kind Lending last week, because they're going to 796. And so that number is important, because the reason to do this would be to get the best terms on that first. Conventional conforming under the $803,000 limit, or 796, or whatever that projected number is and what lenders are using for that. And then you take call it 200,000 as a home equity line of credit second, and then you're putting 10% down, or however that structure is. That's a reason to do it. Is, maybe you're putting 10% down and you want to avoid mortgage insurance. You want to get a great rate in terms on the vast majority of it, about 800,000 of whatever you're borrowing. But it's worth taking a look at, because you might look at it, you might say 1125 times 80%. Like, that's a $900,000 loan. Maybe you find a jumbo company where the terms for this 20% down jumbo are great. And you don't have to mess around with two loans. The second might be adjustable. It really all depends. And, I want to help and look at it. I don't want to say, because I'm a broker, because I got 45 different lenders, I'm going to have the best product for it. But what you might run into is, if you're working with a bank or somebody who's captive and working a specific company, if they don't have the best option for you, their best option for you is quite possibly not the best option.
They got.
Right. Yeah. What were you going to say,
yeah,
John?
no, I agree. Carrie, you take it from me. You should at least do a sanity check with Matt, because, Matt and I are the same when it comes to being a loan officer. Like, half of what I want to do is just make sure you're getting the best deal. And it always makes me happy when somebody sends me a competitor's thing, and I'm like, whoa, I couldn't touch that. Yeah, I mean, it's like, 80% of the time we're going to be the best bet, but on weird stuff, on the edge cases like this, it's like, you never know. I mean, I can't tell you how many times, you're competing with a credit union for a second home or something like that, and I'm like, this is I feel good about what I've offered, and then they're like, can you beat this? And I'm like, whoa, no, this is so much better for you. Please, you have my blessing. So,
and the honest truth is, if something gets brought to me and okay, they structured it this way and that way, if I'm a little better, if I'm a few $1,000s better, you've got a relationship with that person. They've worked with you for 4 months as you're getting ready to buy this house. I'm going to tell you to stay put and close the deal. And you've already got, your pre-approval and your documents and everything all lined up. It would be an extreme case where I'm like, holy crap. At 800,000, if I'm 0.75% better and I'm saving you, $6,000 a year, $500 a month, it's probably something that you for your family's sake are going to want to explore. But, a lot of times it's good, right? Like Sean said, get a sanity check and say, yeah, this is something. But, to answer the question that you asked, for sure, this is something that's done quite often. And it's for these type of purchases, really, between 1.1 and 1.5. You structure it sometimes so that you have a conforming.
Yeah, exactly. If you're not, you don't have $400,000 laying around for the down payment, this is definitely a good way of covering that gap. Troy here asks, hey guys, Max for the first is 802. Yeah, Carrie, yeah, send it over to him. You'll get an instantaneous response or thereabout.
Why did I just I made a comment earlier, it went through, and then I just commented, fire it to matt@mtmg.com, and it didn't send it. Oh, maybe they don't like my email in there.
Technology, man. That's all right. We'll move on to Troy's questions. Hey guys, I'm in negotiation with a duplex in Kansas City, Missouri. Great idea. I mean, it's got to be a great market. Seller wants 250. I offer 230. Also great idea. That's what it comps for. What is the current DSCR rate going for on property that is NOI? Net operating income. Huh? Not as dumb as I look.
Oh, look at you, man. Investor extraordinaire.
17,480. So yeah, so NOI probably isn't really the fact that there is positive NOI is the only thing that will really go to rates. Sometimes the more there is as a percentage of the payment, your rate will get a little bit better. But as long as it's positive, is like typically like where the rates get better. That would be in DSCR world, that would just be having a ratio of +1 or like over 1.
Yeah, and yeah, to your point, Sean, like I'm doing a lot of DSCR stuff right now. I'm so impressed that you're like not even active in the game anymore. You're on the sidelines now, just coaching people up, but you still know the plays.
Yeah, baby. And so the other things, let me keep going. So other things that are going to affect rate are things like down payment, credit, and I mean those are the two things that are really going to be looked at. I mean, there are so many freaking DSCR lenders out there that we work with. We could get you like a smorgasbord. I mean, as far as I am far enough out of the game to not know the answer to like the rates, but I would say, I mean, like if you can pay a point or two, I'm sure you can get it in like the mid 7s, if not like low 7s.
Let me blow your mind, because I've been sending this scenario to our friends at Angel Oak. They've been a great partner, and I priced like something very similar to this yesterday. You could get to probably 6.6 or 6.875 for less than 2 points. You can be
why even buy a primary residence? Just rent, just be a renter, and like you can get a lower rate on your freaking DSCR. What's the minimum down payment? 10%? 20%?
Yeah, but
15%?
These rates I'm talking are like 25% down. I think that's what I priced. And so, like Sean said, if you're putting 80% down or 20% down or 10% down, some of the DSCR lenders are 15. Like that pricing is not going to be good as 25 or 30%. Also, if your credit score is 800, your score is going to be different than if you're 685. And so, for everybody's kind of knowledge, I was talking to somebody with 25% down, 780 credit score, and it was like fairly low, 7.25 without paying any points at all. And then you could get down to 699 for a point. I think 675 for 2 points, something along those lines, which is pretty gosh darn good. Like you said, it competes with conventional. It's pretty close.
Oh, Carrie just sent over the spec sheet. This is great. I love this question and answer session.
Helping people every day. I don't know why I can't respond in the comments anymore.
It's a spammer.
You just cut me off.
Troy, it's gonna depend on down payments and DSCR, the coverage ratio basically, and your credit. But yeah, I somewhere in mid 6s to mid 7s, I think is well within. And this is the kind of situation where like you should probably pay point. I mean, just a bit, again, you got to run the same calculation for whether it's worth paying points on DSCR loans as you do for a house that you are going to own for a long time. You got to consider, likelihood of refinancing, but you also, cash flow is also something worth considering when it comes to paying points. Do you want it to cash flow immediately? How much you want it to cash flow by, and then also like your payment, your rate is the cost of your rate is somewhat dictated by the coverage ratio. So if you don't pay points and your rate's 8%, and now your coverage ratio is only 0.97, then your rate it's like you kind of got to play the game a little bit. So yeah, definitely worth checking it out. We work with so many freaking DSCR lenders, and like getting DSCR loans these days, man, I used to not touch stuff like this. And honestly, I regret talking so much smack about these non-QM loans, like from 2018 to 2022, because first of all, like they deserved it during that time because like everybody sucked at it. There's plenty of other business. The rates weren't very good. Tons of reasons to hate on them. And they weren't being securitized in the secondary market. So like there wasn't a market for them from like big investors. So anybody who offered them was like, anyway, it was always a disaster, right?
Right. You're 100% right. And now, like, as you're saying that, I think to myself, Sean, like every week it feels like a new lender is talking about, hey, we're going to start doing this. And we started doing this 6 months ago, 9 months ago, a year ago. And we do a lot of it. So we're really good at it. Like UWM's doing it. Kind Lending is doing it. Like
that's the crazy stuff. Yeah.
Yeah. All these big lenders are doing it because there's demand for it. And like you said, if there's demand on the front end and the back end, right, you can sell it on the back end. Then the biggest players with the best processes and the best experience are going to get involved. And so you're right. It's night and day. Writing a DSCR loan in 2018 was hard. It was the Wild West.
I think that's like what turned me on to I tried it once and I was like, it was sold to me like, oh, you just need an appraisal and like credit check and like,
and that's how it works now. I mean, yeah.
But that's what they would say. And then they were like, here's your approval. And they would have like 15 conditions. And I was like, wait, and then I would submit them and they'd be like, actually, surprise, there's 15 more. And I was like, this is literally the dumbest thing I've ever done in my entire life. And yeah, now it's way easier.
It's a piece of cake, bro. You should really come back to originating, man. It's so much fun.
Hey, I got stuff that I can do for you to make your originating life.
And I
better.
appreciate it. All right. I got Carrie's email. I'm going to take a look. We're going to see what we can do. I've got another deal going in Colorado. So, can't wait to take a look at this one.
Might have to skip your 9:00 this morning, buddy.
Oh, no. I got to get to my 9:00, but I'll get back to you soon, Carrie. I promise you.
All right, this has been super fun. Love going over the numbers at the macro, the economy level, and love going over the numbers with you guys on the consumer level. Super fun. Always keep the questions coming. We will muddle our way through them as best as possible. And keep an eye on front page of the. I'm going to be honest with you. I get most of my economic news by. I don't even have a Wall Street Journal subscription. I just like peep the front page when I see something that's interesting. Search it in Google and get a free source on that. So if you want to keep up this week, not any huge. Let me confirm that numbers coming out this week. We've got retail sales, housing starts, kind of a nothing burger of a week, which is great. Just means the markets can recover a little bit and ready themselves for the upcoming. Next week's pretty boring too. The next big week is jobs week in a few weeks. So, guys, hope you have a fantastic week. Hope you had a fantastic weekend, and looking forward to seeing you next week. Same time, same place, same folks. Have a great day. See you, Maddie.
See you, buddy.